Hi there, it's Dean Odell with 7 Gables Real Estate in the Odell Group. Today is October 6th. It's time for another Tustin Talks. And boy, this market is changing. We got some news for you. So let's get started on the charts and then we'll follow up with advice at the end. And we're going to get started right now. Okay, so we're starting with the Orange County listing inventory year over year. If you look at the orange line for 2022, you will see we are at 3,646 homes currently on the market in Orange County. Now, remember, we like to look at what was the average prior to all of us having to deal with wearing masks and doing all that kind of stuff, right? So if we look at that, it was 6,400 homes. So we are still far below the average. As a matter of fact, there were 76% more homes on the market before than what we have now. So if we look at that, we're still below normal. But let's look at how many homes did not list compared to normal the last 3 months alone. So in July, August, and September, okay, we're missing a total of 2,563 new homes that would normally hit the market. So this is keeping the inventory down, and we're going to talk about that relationship it has to supply on the next chart. But if you look at where we were last year, we were at historical lows with 2,179 homes. But at 3,646, still not a lot of homes. But what we're finding out is that we don't have a whole lot of demand. So let's take a look at demand on the next chart. Okay, looking at the orange line, we are at 1,598 homes that have gone into escrow in the last 30 days. Compare that with 1,756 just 2 weeks ago. So demand is dropping. As a matter of fact, the 3-year average for demand this time of year would normally be 2,272 homes. So we are 516 sales down from that average. So now if you look at last year, where were we on that red line? Again, an abnormal year. We had 2,500 homes in escrow. So of course, you're hearing headlines like we're down 40% from last year, or last year there was 40% more sales than this year. Well, yeah, there was, that's true, but it was a different type of year. It was an abnormal year. Now, us being down 40% from last year and our current levels of demand, that's the lowest demand we've had since the housing crisis in the Great Recession. We haven't had demand this low, but the problem this time around is completely different, and we're going to talk about that. Looking at expected marketing time, we jumped up to 68 days on the orange line. The last reading 2 weeks ago was 62 days. Last year on the red line, we were at 26 days, and the 3-year average was 86 days. Let's remember that 3 years is before 2020, okay? That market hasn't been normal, or the market has not been normal since then. Now we're going to look at this next chart, which is our expected marketing time broken down by price range. When you look at that, you will see that by every price range, when you compare to last year, our marketing time is up 2 to 3 times longer. So the market has definitely changed, okay? And when you look at the over $2 million price range, that's where you can see the buyers are starting to gain the upper hand. 133 days on the market versus 41 last year, and then it just goes up from there as you go up in price. And that is getting into a buyer's market territory. So why are we seeing this rotation into a buyer's market? Well, let's take a look at the next charts, which I think will explain a lot when it comes to affordability and how the market is changing. Looking at this first chart, you can see the interest rate across the top, and then below it, you could see how the mortgage payment has changed on a $1 million loan. So if you look at where we were January 1st, a payment would have been $4,352 on a $1 million loan. Where we were at the end of last week, we hit almost 7%. So if you look at that, the payment has now gone to $6,653 on that same loan. Now, remember, this is just principal and interest. We're not even talking about taxes and insurance yet. So that is quite a jump. As a matter of fact, if you look at that figure under 7%, you could see that as of today, a buyer would have had to pay $27,612 more towards their house payment. And that, my friends, is a lot of money. And that is what is changing this market. So let's look at this another way on the next chart. So let's look at this last chart, because this is really how most people think before they buy a house, okay? If they know that they can afford a $4,000 a month payment in this chart, which is where people might be comfortable, then at the beginning of the year, when they could have got a loan at 3.25%, they could have gone ahead and bought a house at $1,021,000. Now, if you go to where 7% is, they're at 667. Look at how much purchasing power the buyer has lost, probably about 35% purchasing power. This is the problem in the market right now. The problem is affordability, which I know a lot of us have been wondering how people can afford these homes to begin with, but the reason they were able to afford the prices that we saw was because of the interest rates being so low. Okay, so now we're going to talk about the market and my advice for buyers and sellers. Okay, so what if I told you the Orange County supply and demand model is broken? It's not working. Why? Well, because we have such muted demand and muted supply. And the thing we really need to look at is what is going to change that relationship, okay? We already know the only way that demand is going to go up is for either interest rates to go down or prices to go down. Okay, that's the demand side. Now let's look at the supply side. What's going to cause supply to rise? Normally, we would see in a cycle like this, our supply starting to increase and go up. Why aren't we seeing that? Well, we've talked about it in past episodes. People are in love with their mortgages, I'm telling you. We have 70% of the people in Orange County that have mortgages that are 4% or under. So when you have rates floating around right now in the 6 to 7% range, why does somebody want to sell their house only to trade up to a mortgage with a higher interest rate? So we're seeing a lot less sellers that want to come to the market. They are just staying in their homes, they're remodeling. So all the buyers that are sitting out there right now thinking that there's going to be this just giant massive wave of listings to hit the market, I think we're in a new normal, you guys. This is the new reality. We know that people in Orange County stay in their houses for 20 years. So why is somebody going to move unless they really, really want to or they need to? Okay. So I think we're just going to see less homes coming to the market unless there's a major catastrophe in the economy or something that really prompts people to change their life. Okay. So that is what we're seeing right now on the supply side. So we've got muted demand, muted supply. There's only one thing that can happen here. If people can't afford the house, guess what? Prices are going to go down. And guess what? They already have. Maybe I'm the first to actually say it on tape. Sellers don't want to hear it. Buyers love to hear it. But I'm telling you, buyers, it's the fourth quarter. There's going to be people that want to sell their house. Yes, interest rates are high. There's different ways to get into a house. You can do an adjustable rate mortgage. You can do a buy down where we buy your interest down for the first 2 years of the loan, which always becomes a benefit to you later on if you refi. If you haven't used that prepaid interest, they just knock down your loan amount, buy it. So it's not like you use it or lose it. That's a great way to get into a house. It'll lower your mortgage payment for 2% in the first year and 1% in the second. We just did this on another house at $1,250,000 last week, and the people's payment was $1,100 a month less in the first year and $625 in the second year. So that is the way that you get through these weird times like this. If you can find a house that you like, and you'll refinance coming out on the other end. Okay, so that's a strategy for buyers, or you just wait and wait and wait. Okay, but if you think there's going to be a flood of houses coming to the market, we're not seeing it. We don't know why people would move. We really don't. People have too good of mortgages, okay? Then you've got the seller side. Now sellers, the best market, I said it a couple of weeks ago, it's probably in your back mirror or your rear view mirror. Now I can say without a doubt, it is 100% your rear view mirror. I mean, we've got people out there every day, pounding the pavement, trying to sell homes, this, that. It is not what it was. The market has definitely changed. You got a lot less buyers willing to buy right now. So sellers, you have to understand that you're still way better off than you were just a few short years ago, right? I mean, but These prices have to come down to meet the market and what these people are willing to pay and willing to afford. You can't have people buying houses at $1,250,000 and having $7,000 a month house payments. Okay, so we're gonna work it out. We always do. We're gonna get the buyers and the sellers to figure this out. Temporary buy downs, adjustable rate mortgages. There's always a way to get through the market and get people what they want, but everybody's just got to be realistic and be reasonable, and homes will still keep selling, but they are going to sell at a lower rate because there's going to be less of them available and there's going to be less buyers willing to pay for them. So that's it for this Tustin Talks, and we will see you next time. Bye-bye.